Good afternoon, everyone, and thank you for being part of this virtual event, the fifth webinar in our weekly series, Managing Uncertainty, Adapting to and Learning from the COVID-19 Crisis. You may have been expecting to see Dean Tiff Macklem when you logged in, but don't worry, you're not in the wrong place. My name is Ken Corts. I'm the Vice Dean of Faculty and Research at Rotman. I'll be your host today for this webinar. If you've been online in the last couple of hours, you'll know why. Dean Macklem is in Ottawa today and has just been named the new governor of the Bank of Canada. From all of us at Rotman, I want to send out a big congratulations to Tiff. And as a Canadian, I'm very happy to know that Tiff will be bringing his expertise and his leadership to the cause of strengthening our economy and our financial markets as we navigate the COVID-19 recovery. Each week, our goal is to bring together the Rotman community and offer our evidence-based perspectives and advice to help you cope with the dramatic changes that are taking place as a result of the COVID-19 pandemic. Today's topic is navigating personal finances during COVID-19, what you need to know to take control. I'd like to start by bringing up a poll that invites you to share what might be on your mind today. If you're joining us on YouTube, you won't be able to see the poll, but I'll let you know the results in just a minute after we've given people a chance to respond. I realize that the diverse people from the Rotman community who are joining us today will be bringing a range of concerns. It wouldn't be surprising if you're experiencing anxiety about your current or your future financial standing. Maybe you've lost your job or are worried about finding a job, or perhaps you're employed but worried about your job security. And it's very likely that the market swings have hurt your investment portfolio. Yuta, can you please show us the results? So I'll read the question and the results for those on YouTube who can't see the poll. The question was, COVID-19 is causing a lot of people anxiety about their personal financial situation. What are you most worried about regarding your personal finances right now? Looks like the number one answer at 40% was your retirement account. And then pretty much tied in the high teens are losing your job and not being able to find a job, with personal debt and other or not concerned in the kind of 12-13 range. Great, thanks, Yuta. These are indeed uncertain times, so it's more important than ever to make sound financial decisions. All the basics still apply, but we thought it might be wise to share what our experts have observed about people's behavior at a time like this and what you need to look out for. And we'll share some very practical tips on some key decisions you may be facing during this COVID-19 crisis and beyond. Now let me introduce you to our two very knowledgeable presenters. Claire Tsai is an Associate Professor of Marketing and co-founder of Behavioral Economics in Action Research Center at Rotman. She's worked internationally in financial services. She adopts a behavioral economics approach in her research on decision-making in areas of financial decisions, food consumption, and well-being. Her work appears in leading marketing and psychology journals, as well as in popular media outlets. Preet Banerjee is a consultant to the wealth management industry, specializing in commercial applications of behavioral finance and fintech. As a finance educator, he is a regular contributor and panelist for leading media outlets. He's a member of the Governing Council at the University of Toronto and a member of the Board of Directors at the Foundation for the Advancement of Investor Rights. He's a fellow of the Canadian Securities Institute and holds derivatives market specialist and financial management advisor designations. Most of you will have joined us through Zoom, so feel free to ask questions using the Q&A button on your screen, and we'll get to many of those questions as we can later in the session. Now let's get started, and I'll turn it over to Claire and Preet. I'll start with Claire. Claire, what does research show us about how people are inclined to behave during a time of personal financial crisis or uncertainty? And what should people do to guard against impulses that might not work to their best interest?
Sure, Ken, thanks for having me. Well, let me start by asking this question. In normal times, how often do you evaluate the performance of your investments? That is, check your investment balance. Daily, weekly, monthly, quarterly, annually, every few years, or almost never? Well, we don't have a poll right now, but I'd like you to consider this question as I continue to talk. During a time like this, that is when people see their investment account balance declines in value, and also there's a lot of volatility, they would check their account balance even more frequently and become very risk averse. You probably heard about loss aversion. That is, people are more sensitive to losses than gains. In fact, neuroscience data show that the loss aversion correlates with more correlates more with amygdala activity in the brain relative to gains. And that area is responsible for the perception of emotions, most noticeably fear. So when stock prices fall, investors will feel the pain of losses and become risk averse. What this means is that they will want to sell stocks because stocks now look more risky, and they want to buy the less risky products like GIC or bond funds. They know this is probably not the right thing to do, but fear causes them to want to do this. As a result, instead of doing the right things, that is to be disciplined and stick to their long-term investment plan, they'll end up locking in losses and when the prices are low and missing the market rallies later on. And this happens to smart people too, because it's not that people don't know what is the right thing to do. It is the pain and that fear they experience when they see stock prices falling that prevents them from doing the right thing and making that right decision that they want. It's like trying to resist a slice of very enticing chocolate cake or honey-coated cashews when you're hungry. So don't buy them at all, right? Make that decision when you're not hungry. Same for investment decisions. You need to detach, separate decisions from your emotions. And here are 3 recommendations to bridge this intention decision gap. First, don't look at your account too frequently. In fact, maybe delete the app on your phone that allows you to check your balances or allow you to even trade. Make it less convenient purposely to check your account balance and trade stocks. This way, you'll protect yourself from emotional swings due to short-term volatility and the trap of loss aversion. In fact, there are studies showing that investors who check their balance more frequently will exhibit something called myopic loss aversion, which is worse than loss aversion and cause them to become much more risk averse and have much lower returns on their investment. Second, pre-commitment. Again, separate your decision from the heat of moment. There are many ways to do it. The most familiar one is probably, you know this, to commit to a long-term investment strategy and stick with it. You can set an automatic investment plan with a mutual fund company or brokerage to make regular contribution. You know this. This is not new to you, but please remember why this tool is, this recommendation is very powerful, because it separates you from fear and pain when you see market volatility. You won't even feel losses when the money is deducted from your salary or bank account. You won't worry when you're catching the knife falling, when the stock prices are falling. You won't worry about chasing rallies when stock prices are rising. Thirdly, I'll be quick in this one. Can say more later if you're interested. Put things in perspective. Let's say you have $1 million in your retirement account by the time you retire. 60% would be in stock, 40% is fixed income. Let's say market drops 30% and it never recovers. This is the worst possible scenario and has an extremely low probability. Now your portfolio is roughly a little over $800,000. Think about how you would feel about this 30% drops in stock in your retirement 20 to 25 years from now. And also rather how it might affect the actual quality of your life in retirement. Because retirement income doesn't come just from stocks, but also fixed income, your CPP, OAS. We can do that calculation, and I did that for you. If you count everything, the actual impact on your retirement is actually less than 9% annually. So 30% may feel, oh, I'm not going to have enough money. But if you count everything, every source of your retirement income, stock is a part of it, and the actual impact would be much less severe as it may seem right now. The number doesn't, the exact number, the point is not the exact number, but you get the idea. Putting things in a bigger frame, it will show a far less dire picture, yet very realistic picture than what the stock market alone would suggest, which is a very dire picture, very vivid, but very unrealistic. I'll stop here.
Great, thanks, Claire. Preet, I'll turn to you next. Can you tell us what you're hearing from people who fear they haven't saved enough to weather the financial uncertainty we're dealing with now? And what have you been saying to those people?
Yeah, and thank you very much for having me, Ken. And it's a pleasure to be sharing the stage with Claire. And I could listen to her for the entirety of the hour because a lot of people have been asking about the impacts on their portfolios. From a personal finance perspective, which includes more than people's investment portfolios, this basic feeling that people have is perfectly encapsulated by anxiety. And a lot of that is driven by uncertainty. And when it comes to financial planning, the great thing about financial planning is it does give you this long-term perspective. And it's a living sort of breathing process. It's not a one and done, here's your financial plan, let's see how that plays out, call me in 30 years. It's something that requires ongoing monitoring and review because life happens. And some of these negative events can be, an individual job loss, even when we're in a bull market. What we're seeing right now is a lot more systemic. And so a lot more people are thrown into these crisis situations. Now, personal finance is very personal. And what I've been seeing is that a lot of people who, maybe they're in professional services jobs, they haven't lost income yet, they're transitioning from working from home. Their concerns are more about the balance of now working from home, if they have other people in the household, as well as their investment portfolio. And that's almost a luxury to have if that's your focus, is just what's the impact of my investments. Because that, there are some prescriptions for what you can do, and Claire can give you all of them. She gave you most of the big ones right there. But then you have people who have already lost their jobs or are very close to thinking that they're about to. If we take a look at the distribution of debt and the warnings that we've heard from a number of people, including the Bank of Canada for better part of a decade, as to the level of indebtedness of households, this is now coming home to roost for a lot of people. There's so many people who are living paycheck to paycheck that any slight interruption in income has caused a lot more anxiety about their cash flow situation. And so we're seeing that these different income supports that have been announced, which are coming fast and furious, and they've been tweaked over and over again. This has also caused a lot of people more anxiety because there's so much confusion about all these supports that are now available. So the advice is still the same. You have to avoid making knee-jerk reactions, and to the best of your ability, sit down and refer back to your long-term financial plan. Or if you don't have one, which most people don't, more people are getting more serious about creating those budgets as necessity because they have no other choice, because now they've suffered a loss of income and they have to sort of figure out, well, how long can I last in this crisis mode, especially when I don't know how long this crisis is going to last. So yeah, there's so many different sources of anxiety and uncertainty. And the goal right now from a personal finance perspective is to focus on what we can actually control to reduce those levels of anxiety as best as we can right now.
Great, thanks. Claire, I'm going to come back to you and also fold in a little bit of what we're seeing evolve in the chat on the side here. So I want to come back to Claire and talk about investment accounts and fear again. We're seeing a lot of discussion in the chat about, in particular, what about people who are approaching retirement or who maybe even are already retired, where that time horizon is, in terms of accessing the money, maybe is quite a bit shorter than someone thinking from 10, 20, 30 years out. So what would you say to them about investment accounts and about the fear and the uncertainty and so
on? Thank you, Ken. For people who are approaching retirement or people who are already in retirement, I think they're very two different, even though they're maybe similar in age, but they're actually in very different categories. Because when you're still working, you still have the option to maybe extend working for another year or two to make up for the losses. But then when you're in retirement, that is probably not an opportunity unless you think you would go back and maybe work for a year. But before I offer any more advice, I want to remind everyone, if history tells us everything, recession, downturns, they don't last forever. In fact, the longest one, as far as I recall, the most recent one, that one spans over the course of 2.5 years, roughly speaking. And so during this downtime, if possible, probably draw more, take the money that you need from your fixed income account, which has not lost a lot. Again, this is I'm offering a general principle. Of course, life can be more complicated. And I think you need to sit down and go through your resources and your options. And if possible, avoid selling stocks right now, so that you won't lock in the losses and miss the chance of market rallies later on, which may happen very, probabilistically speaking, it could happen in the near future. I don't know. I don't have a crystal ball in front of me. But again, if history tells us anything, things won't be like this forever. And so I think we just need to be, again, don't make these decisions when you're very, very anxious. And maybe another way to detach yourself from the decision is to get a second opinion, get a third person perspective. If you don't have anyone around you to help you, do one thing. That's one trick that I like very much in behavioral science. Take a third person perspective. Think about how I would feel about this decision, how I would feel about this decision, say 3 years from now or 5 years from now. So do that detachment first, and then again, go through the resources and if possible, avoid locking in losses right now.
Great, thanks. Preet, I'll come back to you now. You talked a lot about the importance of financial planning. What is different about financial planning now? Obviously, 6 months ago, you were having conversations with people about the importance of financial planning as well. What's different about the case now, and how are you? What advice might you be giving now that you weren't giving 6 months ago?
Yeah, it's a great question. Financial planning advice, the basics are pretty timeless. Nothing much really changes. The adherence to that advice changes depending on the situations that we find ourselves in. So for example, you can tell people until you're blue in the face when things are going well that you should still have a budget and make sure that you're spending your money efficiently and putting it away and having a plan. They feel less urgency when things are going well. Now, when we're faced with this uncertainty and this precariousness, people then start to actually say, let's sit down and figure out what our budget is and how we can reduce expenses. So it's not really that the advice has changed, but the receptivity to some of that advice changes depending on what's going on around us. That being said, one of the things that we've noticed in the last 10 years, and I think this is a function of low interest rates and access to credit, is that people have relied on lines of credit, home equity lines of credit, a bit too much for a number of different functions. One of those being as a fallback for having an actual emergency fund. And so the standard advice is, have 3 to 6 months of living expenses set aside in a dedicated emergency fund in cash, something that's liquid, not subject to risk. So a lot of people have said, well, high interest savings account aren't really paying high interest and things are going well. I'm building up assets. Do I really need to have dead money sitting there? Why don't I just rely on this, line of credit that I have access to? And everyone seems to want to give me one when things are going well. Of course, now we're seeing that the other shoe is dropping and credit availability is probably going to tighten as a result of this. It's already starting to. We've seen that some financial institutions in the United States are denying people new HELOCs altogether because they're saying, listen, we don't know if you're going to be able to pay back the money that you're going to borrow from here because of everything that's going on. So credit is starting to tighten. So of all the things that have changed, and again, not much has changed in terms of, the basics of financial planning advice, but the thinking that you can rely on credit in an emergency, that is going to be revisited by a lot of people who thought that that was the case. But now we see how important it is to have a dedicated emergency fund set aside for emergencies.
Great, thanks. We've talked a lot about investment accounts and taking a long-term perspective. We talked a lot about financial planning and budgeting and so on. I wanted to turn to one very specific aspect of this conversation. This is really a question for either of you. A very specific financial consideration in the midst of this pandemic, and that is just to talk a little bit about these government supports, these income supports, the mortgage and rent deferrals, and these kinds of programs. Are there common misperceptions or things to keep in mind when considering these and whether to take advantage of them?
Sure, Claire, do you want to?
Sure, I can start. And you know, well, I think it's very, you know, these are, I would consider these options as resources kind of further down on the list in terms of their cost and priority, because even the interim relief of the rent and mortgages, the delay, that they are actually not, you know, the words may be a little misleading in a sense that they're temporary reliefs, but they come at a cost. To me, they're more like a deferred payment program with added interest. So I would really suggest that everyone who are considering this, these resources, to sit down and calculate the cost. And there are online calculators. You can actually ask for this information from your bank, and probably not from the landlord, but there should be online calculators that can help you figure this out. Like if you defer paying rent for a year or defer paying mortgage for a year, what would be the additional interest that you will have to pay, assuming that you pay it off, you start paying rent a year from now or 2 years from now. And same for mortgage, by the time you pay off your mortgage, that interest actually is quite sizable if you sit down and calculate it.
Yeah, I agree with Claire. There are certain support measures that may not be as beneficial as some people think. And I think the mortgage deferral and credit deferral options out there are a last resort. If you don't need to access those programs, I don't think you should apply for that because it does come at a cost. I think some people get confused because we heard some programs, for example, Canada Student Loans, there's a moratorium on principal and interest payments. So interest does not accrue for that moratorium, which is 6 months for students, which is welcome relief because that frees up a few $100s per month in cash flow. But then when you also hear in the same sort of sentences, well, mortgage relief or mortgage deferral, it's just pushing down the road that obligation. And in the interim, it is accruing interest. And so because you're borrowing hundreds of thousands of dollars, that adds up. So again, if you don't need to access those programs, you probably shouldn't. It's sort of a last resort if you have a severe cash flow crunch and you simply cannot make those payments. So that's sort of a last resort measure. But there are also a number of other measures that have been announced fast and furiously almost every other day, along with tweaks. And for those who don't know, when you have a proposal, it then generally has to be passed in legislation. And normally that process requires 3 readings in the House of Commons, followed by 3 readings in the Senate, and then it receives royal assent, which can take a long time. Now, they've been working overtime, and when they make a proposal and they actually put it into Parliament, in some cases, it can go through all 7 steps in one day. But between the time they make a proposal and when they actually pass it as a bill, it's subject to some tweaks. So we've seen not only a number of different support programs announced, but so many changes along the way. And that's been part of the confusion as well, because some people previously were not qualifying for certain supports. Now some people are. But as we learn more and more about these details, we're also learning about more and more businesses and individuals that kind of fall through the cracks. But this is one of the things that we have to understand. The massiveness of these programs and the speed at which they're being introduced means that there are going to be some areas and features that need to be addressed. And I am hopeful that more of these programs will be tweaked to take into account the people who are being left out.
Great, thanks. I'll turn to a few of the questions that we're seeing in the Q&A come up in the Q&A panel. First, and I think this is for either of you, there's a question about how to think about prioritizing expenditures in the short term. So how to balance, for example, paying back a student loan versus saving versus investing, and just kind of how to think about allocating the funds that are available in the short run.
Sure, I'll take a stab at that one. There are a couple of categories when it comes to our expenses in general. We have the absolute necessities, and then we have more of the discretionary expenses. And right now, the absolute necessities for people who have lost income and are really worried about how much runway they have is food is number one, and also medicine, so prescriptions would be number two. And then paying your rent or mortgage is actually number three, because again, if there's anything that you have some flexibility on, it's not food or the medicine, the drugs that you need, it's shelter and then everything else. And so that would be an example of if you've run out of money, what goes first? It's not food or medicine. Then you start looking at discretionary expenses, and then you would get to, your shelter costs. So that being said, one of the exercises that a lot of people are doing right now is taking stock of their expenses. And there are a lot of expenses that we have that are kind of like furniture. They're just there, and sometimes we've forgotten about them. So for the same reason that saving automatically works so well for people and they forget about it, how much they're saving over a long period of time, in this more subscription-based economy, we have so many monthly subscriptions. Things that I used to pay for one-off, like software, like, a suite of Office products is now a monthly subscription. So we have all these little subscriptions that add up. And so just sitting down and doing a line-by-line check, which is very easy these days because everything is digitized, get your credit card, debit card statements, list out everything for the last couple of months and see what can stay and what can go. And people are finding that they're freeing up a lot of cash flow just by paying attention to some of these little leaks that add up over time in our monthly expenses. So sitting down and going through that exercise is a great way to help provide a bit of clarity, because once you reduce your burn rate and you take a look at how long that can last, some people are finding that it actually lasts a lot longer than they thought, because what they were thinking before was based on uncertainty and not knowing what those numbers were at all. So getting clarity with your situation means sitting down, looking at those numbers and making a short-term plan for your expenses.
Mm-hmm. Claire, do you have anything to add on that topic?
Sure. I love the Preet's responses earlier. I thought that was really comprehensive, but I just want to add a little psychological aspect when you think about budgeting and planning. And because at the end of the day, we also need to take care of our welfare, our well-being. When we cut things to the bone, we may feel a little depressed. And what behavioral science, behavioral economics is really good at is to try to change the framing of things to increase your well-being, to make you happy. And so I like to suggest that when you're setting aside budget for your necessities, for example, try not to think of it as necessities. Try to, for example, food budget. Think about how to make cooking at home fun. And it feels more like a fun activity or fun thing to do, things that will make you happy. For example, I really love chocolate, and during social distancing, I cannot go out and buy my favorite chocolate truffles anymore. So I just make my own chocolate truffles, and the cost is much, much lower than going out to buy those chocolate truffles, which cost more than $5 with tax included per truffle. And so this way, I think we can get a little bit of that satisfaction by just enjoying very economical favorite food that we used to like. And the other thing I wanted to mention is that there's something that's called mental accounting in behavioral economics. That is, when we try to plan for our finances, we would set up mental budgets. You have money for education, money for food, money for this and money for that. And a very interesting bias is that the money in each account is not very fungible. That is, I'm not going to, if I think I'm not going to take money from one account and put it in another one, even if it means I have to sort of get money for the other one that's kind of in red right now at a higher cost. So beware of this bias. I think it would be very good to kind of change our way of thinking about these kind of mental budgets, mental accounts, and just drawing on Preet's sharing earlier, maybe it's a good idea to categorize things into the necessities, to have a bigger, broader account, necessities and discretionary income, and yes, discretionary spending, and try to, and just in summary, so try to have broader categories to avoid making that, committing that mental accounting bias. Second, try to make the necessities fun and hedonic and interesting, so we can also protect and enhance our well-being during this trying time.
Great, thanks. We're seeing quite a number of questions about investment portfolios and things. I'm gathering a number of questions like that. I have one more specific question came through that was kind of related to this recent strain of the conversation. So I wanted to kind of bring that to the forefront first. You guys were talking about being aware of the cost that comes with deferring payments when those are deferred rather than a moratorium where the interest isn't accruing. There was a question in the Q&A about whether you should worry about the impact on your personal credit score if you take advantage of one of these kinds of deferral programs.
Yeah, there's been a lot of coverage on that specific issue because these are new processes. And logistically, what happens is you may have a protocol in place at a financial institution that doesn't take into account that there's a special situation happening right now. So it may automatically say, oh, there was a missed payment, even though they had arranged for a deferral of that payment. So what people are suggesting that you should do is document the conversations that you have with your financial institution if you are going to apply for any type of mortgage deferral or debt deferral whatsoever. And also keep an eye on your credit report. Generally you should be checking one or the other two bureaus once every other year or so, and make sure that that doesn't show up on your credit score. That being said, it's okay not to worry too much about your credit score right now. Focus on the things that are really important right now, like balancing your life with your situation and just making things, getting by on a day-to-day basis. I think people are generally making good decisions with the resources that they have access to. There is going to be some fallout for businesses, for individuals. Some people, yes, are going to see some decrease in their credit scores, but it's not the end of the world. I wouldn't worry too much about it. Just make sure that you're taking some time to think about the choices that you're making. And again, document those conversations if you do take advantage of those programs.
Great. There's another question now, turning more to the subject of investment portfolios and asset mixes and questions like this. Preet, there was a very specific question directed specifically to you about whether someone should rethink their asset mix in light of the current situation.
Yeah, so, taking a big picture perspective, a lot of people, if you do it sort of the right way, quote unquote, you sit down and you come up with an investment policy statement, which says, here's my long-term focus, here are my goals, here's my time horizon, here is my willingness to accept risk. And a lot of, portfolio theory would say, listen, once you've created a portfolio, keep costs low, stick to the long-term plan, rebalance, maybe once a year, and just don't touch your portfolio because it's hard to figure out what's going to happen in the short term. And so most people kind of realize that the short term is unpredictable. And over the long term, we have much more confidence that, markets move up and to the right on those charts. So what happens is, when we have these short downturns, our perspective changes. And like Claire mentioned, we are much more averse to losses than we are to gains, right? So a $10 loss feels roughly twice as painful as a $10 gain would feel good. And so when we see those losses in our portfolios, we start to second guess ourselves. And it's almost like there's, if you're driving down the road and you've got two hands on the steering wheel, it's like a third hand is putting their hand on the wheel saying, let's just take this detour. It'll be much nicer and safer. We just pull over for a little bit. But essentially what you're doing is you're saying, what I have believed about my prudent long-term investment portfolio, I'm just going to throw that out the window right now, because all of a sudden I think I can predict what's going to happen next. Because that's essentially what you're saying is, I think it's going to keep on going down. So now you think you can time the markets, even though you kind of set things up saying, I can't time the markets in the short term. So not only is that sort of the first trap But historically, what happens to a lot of investors who do that, and they sell out of fear and they adjust their asset allocation in order to do that, they then have to think about when do they get back into the market. And a lot of investors, the trap is they wait until there's been 2 years of solid gains before they get the confidence to get back in. But of course, they've lost out on those gains. So I know it is very hard to hear. The advice is don't change your plan, stick to it. But not doing something is not the same as doing nothing. It actually requires a lot of resolve to stick to that plan. But I'm sure Claire would have a lot to add to that as well.
Mm-hmm. Claire, do you want to speak to that question?
Sure. I think what people really is this, when people deviate from their long-term investment goal, as Preet shared earlier, they're actually committing to two evils, making two big mistakes. First, you're locking in losses. Second, it's a great chance that people will miss the rallies later on. But as you know, I think if you have been in the stock market since the Great Depression and just hold on to the portfolio until now, the return is over 10,000% increase. But that's assuming you're in the market every day. But if you're in and out, and you miss the 5 biggest rallies, that return becomes a mere 97%, or something lower than 100%. So I think it's not just locking in the losses right now, as Preet kind of was alluding to earlier. Then you have to decide when you're going to enter. And a lot of people don't want to catch the falling knife, but then when you wait for the market to become more stabilized, you're already missing out the big rallies. And even financial experts, I was in finance before, and I've witnessed even very savvy, intelligent, hardworking financial experts. Nobody can claim that they know how the future would be like. No one knows when the bottom will be. The bottom will become bottom after it happened. And so I think the best really is to have that sound long-term investment strategy, the prudent strategy, as Preet was kind of advocating earlier. I think that part is the most critical component or a step to take in terms of financial planning. And after that is the execution. And as I mentioned in the very beginning, execution can be a little difficult when you're caught up, when investors are caught up with their emotions, when they're very busy mentally or actually or physically working long hours. I know a lot of people actually work longer hours during the pandemic. So when you're busy, when you're tired, when you're fearful, when you're anxious, when things are very uncertain, that is really not a good time to be making decisions.
Yeah, so we've seen a number of comments in the Q&A around kind of where the concern is, should I sell? And you guys are speaking a lot to that. We also had a question though, kind of the flip side of that is, should I buy? Is it even in fact a good time to borrow to buy? One question said, I'm a recent graduate, should I borrow to invest now? Which is an interesting flip side to advice not to sell, is the question of whether it's time to buy. So I ask you to speak to that as well.
Sure. It's a great question because it is something that I'm hearing a lot of. And there's kind of two groups of people who are asking, should I buy or not? And one is people who had money in the market during the great financial crisis. And they look back and they say, I sold, I did all the things that we're talking about. I made all those mistakes and I saw when I missed out. So now they're thinking, all right, is this my opportunity? Can I right that wrong by being more aggressive right now? And then I also have, and this tends to skew younger, people who've grown up in the Bitcoin era and they've seen some quote unquote investments, which I would call more speculations, that have had this volatility that would make the equity markets blush, right? Like this incredible volatility in cryptocurrencies. And so for them, a drop of 20%, 30%, that's relatively nothing. So what I would say is at the end of the day, the question is, can you time the market? And the answer is still probably no. And so we don't know what's going to happen in the short term. And that means it could go higher, it could stay sideways, or it could go down even further. I honestly have no idea. They say there's two types of market forecasters, those who don't know and those who don't know that they don't know. And I think that remains true. So the question as to whether you should back up the truck and invest now, again, my advice is the same. You should have a long-term plan. And it's great that you're not fearful to the point of selling out. You probably have more conviction to stick to your plan and keep adding money as you can. And that's great. But the question as to whether you should invest a lot more than normal, because now you think is a great opportunity, that again leads towards market timing. So again, I don't think people can time the market in the short term. If you have the confidence to invest, do it on a disciplined, long-term focus basis.
Mm-hmm. And, a bit of a related question about changing investment strategies in a period like this, but another question about, is this a time to switch from a passive strategy to an active strategy in my investing? I don't know if Claire or Preet, if you'd like to speak to that.
So
go ahead, Claire.
Yeah, oh, okay. Thanks, Preet. If I were to interpret this question, active investment being picking stocks, actively picking and choosing the best stocks to invest. First of all, I think you would need to, and the passive being automatic deduction from your bank account, making regular contributions to your retirement account. If this is the correct interpretation, I would say that we need to ask ourselves first: do we have the time, energy, and even the willingness to do the work in order to do stock picking and constant monitoring? Because most of us, most of the investors, retail investors, we have a full-time job, and other demands in the family, life can easily feel like 2 full-time jobs. And on top of that, you're going to add another full-time job, active stock portfolio management. So we need to be very realistic about that. And even so, assuming that requirement is met, then I think we need to also have the right attitude, the right mentality with investment. If we are thinking about long-term, that is, am I doing this to speculate, or am I willing to buy a stock and just hold it for 5 years, like buying real estate? Assuming this company is going to, I have faith in this company is going to do well. It's not just a quick gig. So I think these are the 2 big questions I would ask myself before when I consider this decision, this switch.
Yeah, and I'll add, because I get a question like related to that all the time. When we are in a bear market or stocks are going down, is there more value in having an active stock picker? And I'll go back to, there's a little white paper written by William Sharpe, Nobel laureate for his contributions to modern portfolio theory. And he basically said, listen, there are basically 2 types of investors in the world. You've got passive investors who hold the market, and therefore they get the market return. And if you had a second room of all the other types of investors, they would be active investors, and they're buying and selling against each other. And therefore they are the market, right? That's how you make a market. You've got buyers and sellers, and they're all buying and selling against each other. And so because they are the market as a group, they get the market return as well. So when you take a look at these 2 groups in aggregate before costs, they both earn the market return. But after you deduct costs, the passively held investment dollar tends to outperform the average actively invested dollar, because it's a lot cheaper to just mimic an index than it is to hire a lot of people to try and do the research to try and beat an index. And so that mathematical proof holds true in an up market or a down market. And what I would add, 2 things. 1, the best investment portfolio is the one you can stick to. So there's some people who have trouble wrapping their mind around the idea of a passively held investment fund because they feel like no one's at the helm. And so they are more likely to switch out when things get bad because they think, no, now is when active will do better. But the other thing to consider is logistically, if you are, say, a fund manager, you've got an additional handcuff. And that is that when markets go down, people want to sell. And that means you have to hold more of your portfolio in cash. which means you can't deploy it to buy those opportunities that you might see. So, the evidence on balance suggests that minimizing costs and just sticking to a portfolio are the two best things you can do. But I know that the idea of passive versus active is something that gets debated, internally a lot. And if you don't have the resolve to stick to that strategy, even though it might be academically superior and it causes you to sell out, that's another thing you have to factor into your calculus as well.
Thanks. I was going to turn to a couple of questions we see in the Q&A around housing and mortgages. So one question there is this a good time to buy a house? Is it a good time to get into the housing market? It's an awfully big purchase to make at a time like this, even if the conditions might be favorable in some ways.
Maybe I'll take the first crack at it. So I've also been following the real estate market in Toronto. I'm assuming this question is about the Toronto real estate market. And if you look at the weekly data since February, so there are two things to pay attention to, right? The houses or the apartments that you purchase and you plan to either live in, or you plan to, you're buying them as an investment property. And surprisingly, but not surprisingly, usually real estate doesn't act as fast as stock market. Is sort of lagging, and I'm not seeing price dropping. You may actually see the average closing price decrease a little bit over time, but no, pay attention to the kind of properties that's being sold. They're usually smaller, less expensive properties that are in these transactions that have been closed. The more luxurious sector, there's just not much going on there. So I have not seen a decline in the price very much in Toronto. And if you're thinking about investment, keep in mind, a lot of the buildings now do not allow Airbnb to operate in their buildings. And so a lot of the Airbnb operators, they're switching to long-term lease, and that increased the supply dramatically since the lockdown. So something to keep in mind. Just it's a very simple supply-demand rule for you to consider if you want to get into the investment condo market.
Great. Preet, did you have something to add there, or?
Yeah, I mean, I've always got thoughts on housing and real estate in Canada. It's a cocktail party conversation of choice for the last decade. See, a friend of mine's a real estate and credit analyst, and I follow his research notes. And it's true, we haven't really seen a decline in prices yet. If we take a look at some of the rental markets, we're starting to see some softening. There's some leading indicating data that says, the months of inventory is starting to increase. For the first time in as long as I can remember, landlords are offering incentives to move in and rent their apartments, including a cash incentive or no requirement for last month's rent. So they're offering incentives for the first time, and I think a lot of that is going to be regional because, as Claire mentioned, the Airbnb rentals, sometimes they're just not allowed to operate because of the distancing requirements and what have you. And so there's a couple of condos that are almost exclusively Airbnb rentals in the background, downtown Toronto. And from what I understand, no one is renting an Airbnb right now. And there are all these real estate investors who now don't have the income to support those mortgages. And so there might be some selling pressure. But at the end of the day, every market, interest rates, stock markets, bond markets, real estate markets, I don't know what's going to happen in the short term, but I know a lot of people are looking at the possibility of the impacts down the road of people losing their jobs and people not being able to fill their investment properties. And if that is the case, the supply and demand would suggest that that could lead to a softening. That's what people are thinking, but we don't know what will actually happen.
Yeah, if I may just add one more thing. There is that investment opportunities because of potential softening in price, but we have not seen that. People have been speculating it, expecting it, but we just have not seen that. In fact, 2 weeks ago, average rental price increased. So I think the last 2 weeks of April, the rental price at lease, the cost of lease actually increased. And the other thing I like to just suggest everyone consider is that it may be harder to apply for mortgages now. Banks may be imposing stricter criteria in order for borrowers to get the approval. And also people may want to think about, do I have enough cash flow, and which is kind of stable in the years to come? Because what you don't want to end up happening is that you hold a few properties and tenants cannot pay, and you cannot put a stop on the mortgage payment because you didn't pay with cash. And so definitely don't want to end up being in a situation like that for an extended period of time.
Another question about housing was someone asked in the Q&A, is this a good time to renegotiate a mortgage or other debt for that matter?
Yeah, I'll take first crack at that. It depends on a couple of factors. You have to make sure that if you're renegotiating mortgage, whatever mortgage penalties that would exist for breaking your existing mortgage if you're in the middle of a term don't outweigh the potential savings that you're negotiating. So there'll be a couple of functions for that, who your lender is and what their specific practices are for calculating the mortgage break fee. And then also what the differential is between the interest rate that you're paying now versus what is available on the market. So if you've had a mortgage for maybe you're in year 3 or 4, maybe there might be a bigger differential than if you got one just a year or two when interest rates are already pretty low. So you have to sit down and do the math to sort of see if it works out, but don't forget to factor in the cost of breaking a mortgage when doing that differential calculation.
Okay, great, thanks. I think as we start to approach 2 o'clock, I'll just ask each of you if you have any kind of closing thoughts, closing advice or thoughts you want to share, and we'll bring this very fruitful discussion to a close here in the next few minutes, I think.
Claire,
Preet, do you want to go ahead?
Sure. Maybe I'll just offer a quick summary of my sharing today. First, really want to urge everyone to protect ourselves from the negative impact of the emotional swings that's easily triggered, frequently triggered by the volatility of the market conditions. And we can help ourselves by checking our account less frequently and delete that trading app on your phone. You still have online banking, you have online investment account. I know, but as you try to go online and enter your password, you may be reminded, maybe I need to calm down. Maybe I need to calm down. Changing things on the phone is too easy. And and also pre-commit to a long-term plan. And don't, as we both repeated several times, and hopefully this is not too repetitive to everyone, but we think about the implication of our action of deviating, and are we making the decision at the right time lastly, try to put things in long-term perspective. Things won't be like this forever. When we're at a trial, the trend should be upward. So I want to thank everyone for your attention, and I wish you all the best.
Thank you, Claire.
Well, I think Claire summed it up quite nicely. And so what I'll do is instead of giving another closing statement, I'll give sort of a little actionable tip. And this is, and bear with me. So credit card balance protection insurance is usually something that many experts say, do not get that. And for those of you who don't know, it's basically pay an insurance premium on your credit card statement that would protect you in case you lost your job or income, and it would cover off your minimum payment. The premiums are very high, and the likelihood of making a successful claim has historically been pretty low. And this has been a product that's been very aggressively missold by a lot of financial institutions. So the tip is this: if you have lost your job, check to see if you had accidentally signed up for this without your knowing, because you'd be surprised how many people have. And there was just a story that came out just yesterday documenting all these people who were alerted to the fact that they had been paying this insurance without their knowledge. And since they had lost their job, they should make a claim. And I think collectively they got a few $100,000 worth of credit card balances paid off. So if you have unfortunately lost your job, check to make sure that you weren't unknowingly paying for this product, which again, we don't recommend. I'm not saying you should go out and get it, but if you happen to have had it because it was missold, make that claim so that at least they're paying your credit card bills for you in the meantime.
Great. Thanks, Preet. Thanks, Claire. Thank you both for making this such a practical and fruitful discussion. Personal finances are, of course, very personal, but I suspect that many people are now feeling better informed through what you've shared and are taking away some tips they can put to good use in their own individual financial decision-making. So thank you both. And thank you all for joining us. Remember, Managing Uncertainty is a weekly webinar series, and I hope you can join us next week when the topic will be the first of a two-part series looking at the impact of COVID-19 on supply chains. The first will consider what's happening with international trade and the rise of protectionism. If you missed any of our previous webinars, you can find the recordings on our website at rotman.utoronto.ca. Thanks again for joining us today.
Thank you.